Hello and welcome to our Q3 2025 Global IFRS Update webcast. We have our agenda here on the screen for you today to see, and you will see that we'll talk about quite a few things. Firstly, some of the current IASB projects that have just completed and those that will complete later on this year. Secondly and thirdly, we will cover the upcoming exposure drafts, so a little bit forward-looking, and also a post-implementation review on IFRS 16. Finally, at the end, we will round up with the latest sustainability reporting developments. My name is Olaf Pusch, and I'm joined today by our global financial and sustainability reporting leaders, Martin Boucher, Helen and Olivier Scherer. It's great to have you all here. Welcome. During the first section of our webcast today, we will discuss some of the IASB projects that have recently been completed and those that are expected to be still completed during 2025. And the first project that we want to cover is one that will be completed by the end of 2025. In fact, next month we expect it out. And it's the project on disclosures about uncertainties in the financial statements as illustrated using climate-related examples. And Martin, perhaps you can start explaining to us why the IASB embarked on this project in the first place.
Yeah, so as background, the International Accounting Standards Board received concerns over information in the financial statements over climate-related risks. And the concerns were twofold. I guess one, that insufficient information was included in the financial statements, and two, that the information in the financial statements was inconsistent with information outside of the financial statements and other general purpose financial reports, such as a management discussion and analysis. And so the IASB embarked on that project back in March 2023. And with its sister board, the International Sustainability Standards Board, they have worked the IASB on developing examples that would be consistent with sustainability disclosure requirements. And the last piece on the background is that while the examples are focusing on climate-related risks, they're not meant to be limited to those uncertainties. And so they may have a broader application than simply climate-related risks.
Yeah, and I understand these examples don't really add to existing requirements and they don't take anything away either. But they are, as the IASB puts it, accompanying the related standards, right? Rather than being part of the standards. So what does that kind of notion mean for preparers? How should they read that?
Yeah, and that's a very important point, Olaf. And what it does not do is change any existing recognition, measurement, presentation, or even disclosure requirements. And so rather, what the examples are meant to do is provide additional insights as to how to apply existing disclosure requirements. And what that means is that the impact will vary based on the entity. It will depend on the starting point. It will depend on how detailed were information in the financial statements over climate-related risks, as well as how consistent was that information with their financial reporting outside of the financial statements.
And there are 6 of these examples, right? We've got them on the slide here. Do you want to take us through what do they entail? What guidance do they try to give?
Yes, and so I'll go through each one in summary, and obviously this is for preparers and viewers to go into details to the extent it may apply to them. And so the first one is very much a materiality judgment. And so this is an example that focuses on perhaps a lesser known piece of IAS 1, which is the general presentation of financial statement standard. And so there is a paragraph 31 more specifically, that has 2 components to it. The first one is that to the extent a specific disclosure requirement does exist, but it is not material to an entity, then you do not provide it. So usually people know about this, but it does carry on that paragraph to say that you are meant to consider, after the application of every and any detailed disclosure requirement, you are meant to stand back and assess if sufficient information was provided and allows users of the statements to understand the impacts of conditions, events, or transactions on the financial position and the financial performance of the entity. And so example 1 is building on 2 scenarios. One, the first scenario where looking at the result after the application of detail specific requirements, there is something missing and then additional disclosure is provided. And the second scenario is the contrary. And so also looking at the sum of all the disclosure and assessing that no material information needed to be provided to be compliant with the overall presentation requirement and disclosure requirements. Now, examples 2 and 3, they work together in a way in that there's a bit of a build-up from 2 to 3. So let's start with example 2, which is applying disclosure requirements in a specific IFRS accounting standard. In this case, it is IAS 36 on the impairment of assets. So the entity in the fact pattern has greenhouse gas emission requirements, and in determining the recoverable amount for the assets being tested for impairment, this becomes a key assumption. And so the cost of requiring emission allowances is a key factor in assessing if it is recoverable. And so existing IAS 36 disclosure requirements would apply. This becomes business as usual, if I can say, and then you would apply those. Now, example 3 is a bit more nuanced, because example 3 is saying it is possible that once you've exhausted all of the specific disclosure requirements in, again, IAS 36, you need to supplement that. And so the fact pattern that is used is one where the assets being tested for impairment do not contain goodwill, do not contain indefinite life intangible assets, and there is no impairment. And so IAS 36, impairment of assets in this case, would not require specific disclosure. And so example 3 then says you are not done. You are meant to go back to IAS 1. You're meant to look at a paragraph that talks to sources of estimation uncertainty. Look at whether or not there is enough gray, enough uncertainty about future outcome that would warrant additional disclosure, even though IAS 36 directly does not require it. And obviously the answer in that example is yes, you would have.
Yeah.
Then moving on to example 4, which is from the perspective of a financial institution in looking at how climate-related risks may impact their asset portfolio and how did we be able to recover it. And so impact on exposure to credit risk, impact on credit risk management policies. And so one of the examples they use in that fact pattern is how climate risk has been incorporated into the measurement and calculation of the expected credit loss. So then we move on to example 5, which is a different fact pattern yet again, this time dealing with the provisions standard and more specifically with decommissioning and site restoration obligations. And so the entity in that fact pattern has applied IAS 37 provisions, has measured correctly its site obligation, restoration obligation, and then they consider if there is something missing about some of the key assumptions that have been used in their calculation. And the fact pattern implies that yes, the timing of the site closure is a major assumption that should be disclosed, because while the measurement is correct, it is a key assumption in the calculation itself. Mm-hmm. And then our last example is actually forward-looking at the moment in a sense that it is applying IFRS 18 on presentation and disclosure in financial statements and look at our new principles of aggregation and disaggregation. And the fact pattern used is one where for a class of property, plant, and equipment, they will determine that certain items in there are showing a dissimilar characteristic, to use the term in IFRS 18, and as such would warrant creating 2 types of PP&E items. So one that is less exposed to climate-related risk and one that would be more exposed to climate-related risks.
Okay. Thanks. That's really helpful. Coming to the expected timeline of these standards, I mean, unsurprisingly, because they're not standards themselves, there's no effective date, right? So when do people need to start gearing up for this?
Yeah, and that is a very interesting question because, as you've mentioned, this is not a new IFRS accounting standard. It is not an amendment to an existing accounting standard. The examples will be accompanying the existing accounting standards. And so, as you mentioned, no effective date, no transition requirements. And so in theory, they are effective as soon as they are published. Mm-hmm. And so that is very much why the IASB, in order to provide a timely adoption of these examples, has gone with a near final draft in July 2025. Hopefully next month, we shall see the final release of these examples. But the key concept here is one of sufficient time. And so the IASB was trying to give sufficient time for preparers, entities to consider the guidance, determine if new information is required, changes to systems, processes, controls, in order for them to apply the guidance in there to the extent it may provide new insights. And we're discussing months, not years, to be very clear. And so we would expect that for most of our clients, by the time we get to our December 2025 period end, sufficient time should have been provided to consider those examples.
And if an entity now, come December 2025 for the year ends, puts additional disclosures in because of these examples, probably the question arises, well, what else does that mean for disclosures? Do I need to say, this was an error because I didn't have this last year? Do I need to put comparatives in? Are there any other kind of tips and tricks you can give entities as they disclose this for the first time?
Yeah, so as a general statement, so to the extent that we can point to the examples as being the trigger for a change, and that the examples provide new insights as to how to apply those existing disclosure requirements, so that would lead to a conclusion that this was not a prior period error. It is leveraging the new insights provided from the examples. Now, on the other point about comparative, so yes, we would expect that if new disclosure is needed to the extent it is relevant, then yes, comparative information will be required. And perhaps the last one, a bit more minor, but because again, it is not a new accounting standard nor a change to existing accounting standards, you're not directly in scope of the required disclosure on the adoption of new accounting policies, but it may be good voluntary disclosure to indicate that these examples were considered in the preparation of your period end financial statements.
Okay, thanks. That's very helpful. I'd like to wrap it up for this first one and move over to the second project that we want to talk about in this section of our webcast here. And this is on IFRS 19. So it's a standard that was actually issued last year already. So this is about subsidiaries that do not have public accountability and what kind of disclosure simplifications they can avail themselves of. And there has been an amendment now that was actually issued last month by the IASB to IFRS 19. And the effective date of the original 19 is 1/1/27. So I guess that begs the question, why were amendments now issued to a standard that wasn't even effective yet?
Yeah, I guess that is a fair question. And so, and maybe for background before I address the question directly. So IFRS 19 is a relatively new standard. It is a disclosure only standard. And so it does not change recognition, measurement, presentation requirements, but for eligible subsidiaries, it may allow those entities to benefit from a reduced set of disclosure requirements. So that's the obvious benefit from using IFRS 19. Now, IFRS 19, when it was published, was based on IFRS accounting standards as they stood back in February 2021. And then from May 2024 onwards, amendments to IFRS accounting standards will then be reflected directly in IFRS 19. And so we have a gap. So there's an interim period when changes to IFRS accounting standards were not reflected in IFRS 19, and that is what the amendment is trying to cover. So trying to bring into IFRS 19 the changes that were made in that interim period. So think of IFRS 18, for example, financial statement presentation and disclosure. Think about lack of exchangeability on foreign currency, Pillar 2 in income taxes, supply finance arrangements, or the relatively recent amendments made to IFRS 9, IFRS 7 on classification and measurement of financial instruments. So all those are now brought into IFRS 19.
Okay. And what's the effective date for these amendments?
Well, the same, in that it's all aligned to periods beginning on or after Jan 1, 2027.
Okay.
Yes.
Yeah, that makes sense. Thank you, Martin. So now moving over to the third project, and Helen and I move over to you on this one because this deals with an area that you take a keen interest in. That's IAS 21. The standard deals with the effects of foreign exchange. And there's an amendment on the horizon to IAS 21 that deals with the translation of amounts from a non-hyperinflationary currency into a currency that is hyperinflationary. Now that sounds a bit of a niche project, but maybe you can tell us what entities this applies to, and then maybe people will start to realize that it could actually apply.
Sure, no problem, Olaf. And I think the project itself is quite narrow, and it only looks at a situation where the presentation currency is that of a hyperinflation economy, and the functional currency of the entity or the foreign operation itself is that of a non-hyperinflation entity. So it is going to be quite narrow. It might not impact too many people. But by way of an example, it's a situation where, let's say you have an Argentinian entity that has a functional currency of USD but presents financial statements in Argentino pesos, Or if you have a Turkish lira entity that has foreign operations that are in euro and then obviously get consolidated into that hyperinflationary entity. So, for those that will be impacted, it will have quite a substantial impact.
Okay, so that's helpful background, but what do the amendments now actually tell us to do? Because there was obviously a gap before.
Yes, of course. And in short, what it basically says is for those entities, you have to use the closing rate, both for the comparative period and for the current period. Now, there's one exception that says, well, if you're doing consolidated financial statements and the functional and presentation currency are that of a hyperinflationary economy, then for any foreign operations that get consolidated, let's say it's euro, for those, you wouldn't restate those comparatives using the closing rate, instead, you would basically take whatever the prior year numbers were that were issued in those financial statements and use whatever the changes in the price index are from an IAS 29 perspective that you've applied to those comparatives.
Okay.
So that's in short what we need to do.
That makes sense. And what's the expected timeline on these amendments?
So the amendments should be finalised now in 2025, and the effective date will be 1 January 2027. So there is a bit of time, but obviously for those entities impacted, they need to start thinking about it now already.
Okay. Thanks, Helen. There's one more project actually in our first section of this webcast here, and Martin, I want to come back to you on this one. So it's actually a brand new standard that we expect by the end of this year called IFRS 20, quite exciting. Can you tell us what IFRS 20 is trying to achieve?
Yep, so IFRS 20 will be about regulatory assets, regulatory liabilities. It will be superseding existing IFRS 14 on regulatory deferral accounts. And so we are dealing with entities subject to a regulator. And so think of a power or water utility where they render the service, they provide the goods, and the tariff they will charge to their customers is subject to oversight from a regulator. So happens in instances where there is limited competition, for example, or a monopoly. And so under the proposed standard, which we expect, again, to your point, to be final very soon, this will deal with the timing differences. So the timing differences between when the entity renders a service, provides the goods, and when is it that the regulator will allow that entity to charge their customers. And so ultimately what it says is that an entity's right to add to a tariff in the future becomes a regulatory asset, and then conversely, an entity's obligation to reduce a rate in the future becomes a regulatory liability. And so both regulatory assets, regulatory liabilities will end up on the statement of financial position. Regulatory income and expenses will form part of the statement of profit or loss. And the objective remains that by doing this accounting, this provides users of the financial statements with a better appreciation for those timing differences and how it's impacted the performance of the entity, but also a better outlook on cash flows. And so what is coming in terms of cash flows for that particular entity.
Okay, thanks. That's a big new standard, lots of work, lots of new processes for impacted entities. What's the timeline on this one for those that need to follow it?
Yeah, so it should be effective for entities in scope, I guess, and for reporting periods beginning on or after January 1st, 2029, which sounds like it's far away, but for those impacted, as you mentioned, it may not be that far away, but it's also in a time when other standards have to be applied. So again, I mentioned IFRS 18 earlier, and so I suspect 2029 will come quick.
Okay, great. Well, thanks very much. And that concludes our first section of this webcast. We move over now to the second section, which is the upcoming standards, upcoming projects, so exposure drafts that are on the horizon, so a little bit more future looking. So Helen, there are actually two, I think, that fall again into your remit. Maybe you can tell us about them.
Yeah, so I think the first project is one related to amortized cost accounting. I'm sure most companies use amortized costs either for their financial assets or financial liabilities. So this is the first one that I think the IASB started to look at for targeted improvements.
Yeah, as you say, this is quite a big one, right? Every entity pretty much will have to use IFRS 9 amortized cost model. And what's the reason? Why did the IASB pick this one up?
So as part of the post-implementation review of IFRS 9, I think there were some challenging areas that, people weren't getting consistent views on from an amortized cost perspective. So the IASB decided, as part of their PIR, they went and did some research and decided, this is probably an area that they could give helpful guidance on.
Mm-hmm. Okay, that's great. And you did mention the word targeted improvement before. What does that specifically mean for this project?
So I don't think you'll see a total rewrite of amortized cost accounting, but what you will see is maybe some additional clarifications, maybe some application guidance that will be issued.
Okay. And we see on the slide here that the project was actually added to the pipeline a number of years back. What's the current status of this?
Yeah, so I think at the moment, in about Q3 of 2024, the IASB started to do some discussions, some outreach, speaking to some of the parties that, obviously use amortized cost accounting quite a bit, and came up with some of the topics, the scope, the objective that they want to achieve from the project. And so that was tabled at the board meeting in February 2025. Mm-hmm. And then in June 2025, the IASB meeting, they decided to actually add it as a standard setting project. And there's some key areas that obviously would need to be considered. So one of them would be around the initial recognition and determining the EIR, because in some cases, there's multiple cash flows that could occur. And so how do you determine the EIR? Is it a best estimate? Do you use a weighted average? So that would be one of the considerations. The second one relates to modifications and, what is a modification? When does it result in derecognition, for example, and when is there partial derecognition? The other one, which is, I think, a bugbear for many, is sometimes the cash flows change because of changes in interest rates or other factors along the way. And so how do you account for those? Do you, account for those changes going prospectively, or do you do some cumulative catch-up as a result? So there'll be some clarification on that as well. And then lastly, when there are changes in cash flows, again, sometimes is it a result of impairment? Is it derecognition, modification? So, it's always a little bit unclear which one comes first and which one comes at the end. And so there'll be some clarification possibly in that area as well.
Okay. And I guess next steps then, the eagerly awaited exposure draft on this one, right?
Yeah, so I think it's a little bit away, if I'm being frank. I think it'll be Q2, or second half of 2026.
Okay.
But it will impact and may impact some entities quite a lot, depending on, where the board go to with some of the guidance or clarifications.
Okay. Thanks, Helen. That's helpful. I said there was a second project in this category for exposure drafts that we're waiting for. The next one is called Dynamic Risk Management, or DRM. And I guess that's a particularly hot topic for banks, right? So can you tell us a little bit about that project?
Yes, so I think this one's been on the cards for a very long time, and you can see from the slide it started around when we were discussing hedge accounting in IFRS 9. They decided to exclude that from the improvements in hedge accounting, what we like to call micro hedging, and rather looked at it on what we refer to macro hedging, because it's more on a dynamic basis. So basically what happens is, interest rates, when they look at it, especially for banks, they manage it on a portfolio basis and over a time horizon. And so you often have new assets coming in and some being removed. And, the current hedging model doesn't necessarily take that into consideration, looks at a specific item that you're hedging. So this project will deal with that, because it will look at how banks are actually managing their business dynamically, and then to try and reflect that into the financial statements. Because, obviously we want a link between how risk management is taking place and then how that translates.
Okay, thanks. We've got the timeline on the slide here as well. What can we expect next on this particular one, on the DRM?
Well, why we really wanted to mention this is we are actually expecting an exposure draft now in December 2025. And actually there's a 240-day comment period, so it's quite long.
Yeah, that's twice as long as, I guess, what we would normally expect, right? 120 days, I think, is what we normally have. Probably rooted in this case in the complexity of this one, given the fact that, as you've explained, that it's been on the cards for such a long time. It is quite complex, and that's reflected in that extended comment period.
Yeah, and I think what they want is banks in particular, or financial institutions, to actually test the model to see if the core principles, actually work, and is it actually achieving the objective that the IASB set out to achieve. So I think it's good that they've given a longer length of time, because obviously we need to possibly build models, make changes. And how does that translate into operating systems? Does it actually work as intended?
Okay, great. Well, that concludes our second section, and I'd like to move over to the third one, which is the post-implementation review. And there was a request for information for the PIR on IFRS 16, the LISA standard, and that's currently open for comment. Maybe you can tell us a little bit about that, Helen, and also maybe a little bit on PIRs in general.
Yeah, so look, IFRS 16 PIR, or post-implementation review, has now been issued, and the IASB had asked specific questions around, is it working as intended? So the PIRs in general are part of the due process that the IASB has to undertake, especially after the standard's been in play for a couple of years, to actually see, is it actually working as intended? Are there any really big fatal flaws that need to be considered? So, we've been through a few of them already, and now it's IFRS 16's turn. Right,
okay. I mean, 16 obviously was a massive change for a lot of entities, particularly lessees, that had to bring a lot of balances on the books, assets and liabilities. So I expect there's probably a lot of comments that have been stored up over the years. Are there any particular ones that you would want to highlight that came up as issues?
Yeah, so I think when we look at what we're going to, consider as a point to raise in a PIR, it has to be very pervasive. It almost has to be a fatal flaw, that this thing is just not working as intended. I don't think we have any that we think are fatal flaws, but one area that we do plan on raising with the IASB is when we have sale and leaseback transactions, sometimes the interplay between IFRS 15 and IFRS 16 isn't quite clear. And so, that's an area where you could get quite diverse answers. And so we're probably going to put that in our comment letter to the IASB as something to contemplate in their discussions.
Okay, got it. That we will raise sale and leaseback.
Yeah.
Great. As a reminder to everybody, I think the comment period is still open until the middle of next month. So we still have about until the 15th of October to raise comments to the IASB. Thanks. Now let's move away from financial reporting and move over to the sustainability reporting. That's our last section for today. And Olivier, I come over to you on this one. There's always lots of developments on the sustainability front. And in fact, in previous webcasts, we've talked about the Council of the European Union and the European Parliament, looking at amendments to directives, particularly the Corporate Sustainability Reporting Directive. Can you maybe remind us a little bit on why these amendments were being made and what the status is of these?
Yes, indeed, a lot of developments. So I think we have to understand that the CSRD was released a couple of years ago with a level of ambition that was quite high. And it appeared that it was maybe the bar was set a bit too high. And so the European Commission came back and said, well, we need to find a way to reduce the reporting burden on preparers. So the stated objective is to reduce the reporting burden by 25%, not only on sustainability reporting overall, but sustainability reporting is a big part of it. So many different actions were taken. I can take two categories. One is, well, let's give us time to do it. So for that purpose, it started with a so-called stop the clock directive. So that stop the clock directive applies to wave 2 and wave 3 preparers and beyond. So these are those which are not yet reported, and which would have reported as early as 25 and future years. So for those ones, they said, well, let's postpone everything and we give you 2 additional years. So those that were supposed to report in 25 will first report in 28 based on 27 data. So that's the stop the clock. The other one is more for the wave 1, so those who have reported based on 24 data in 25. And it's called a quick fix delegated act. And what does it do? It basically extend the phasing in provisions that we had in the ESRS. So allowing another 2 years of extension of those phasing in provisions. And it is also granting some additional reliefs, particularly I can take the example of biodiversity information, for which there are also some additional reliefs. So it's just to save time. You know?
Okay.
And during that time, what's going to happen? Two things. One is to allow time for the European Commission to revise the CSRD itself. And also the European Commission gave a mandate to EFRAG to revise the full framework of IFRS. As a result of that mandate that was given by the European Commission to EFRAG in February this year, allowing an extremely short period of time to revise the 12 standards, EFRAG released at the end of July an exposure draft with a revision of the 12 standards.
I guess there are quite a few ESRSs, right, you said, and I guess the revision is to simplify them, right? Can you tell us what levers EFRAG pulled to simplify these ESRSs?
Yes, so it's a comprehensive project. EFRAG identified, so to simplify, 6 levers. I could say maybe it's 2 plus 4. 2 relates to how the ESRS framework is set up by first eliminating various redundancies that we had within the framework. And 4 additional levers on the content itself. So those 4 levers relate to first making the assessment of double materiality easier for preparers. It is about granting some additional reliefs in the ESRS to make the production of the data easier as well. It is about making the sustainability reports maybe easier to read and also more concise, and for all that without forgetting that there is an objective of interoperability, and so improving at the same time the interoperability with the IASB's framework.
Okay. And what are some of the areas that are being simplified in the exposure drafts?
So we can name a few. In terms of structure, there were some mandatory disclosure requirements that we could find in the 10 topical standards. All that has been condensed into a cross-cutting standard. It's the application requirements, which to a certain extent either have been deleted, or they have been clarified, or they've been moved into a set of non-mandatory implementation guidance that will be put aside from the 12 standards. It's also about offering the option to produce an executive summary that would be part of the sustainability report, but that would help as well the reader in the understanding of the report in itself. It's about allowing to add appendices to clarify and provide additional information on some of the disclosures made in the sustainability report. I mentioned earlier, as part of the levers, some simplifications to perform the assessment of double materiality. It includes the possibility to have a sort of top-down approach, and also when certain things appear as being clearly material, allowing to reduce the documentation efforts on either it's extremely material or it's clearly not material. Maybe it's not necessary to document that in the same degree of detail as when it is borderline. It is also about providing a clarification that the ESRS is a set of fair presentation framework. There was debate as to whether it was a fair presentation or a compliance framework, and it is something that was made clear in the proposal that it is a fair presentation framework. some clarification as well, and some reliefs associated with the reporting boundaries. There are certain exceptions that can be taken into account when reporting. I can give the example of water. If water is assessed as being a material IRO somewhere within the group, but not everywhere, then the metrics associated with water could be limited to only where is material, not to the entire group. Some additional reliefs as well were granted, particularly for acquisition and disposals in the year of acquisition or disposals. And the introduction of the notion of undue cost or effort that we didn't have and that has been introduced, and also to facilitate the interoperability with the IASB that had that concept. So that's some of the examples that that do illustrate the various simplifications that were made.
Yeah, I'm hearing a lot of change for the IFRS. When does the comment period end?
So
for the exposure draft?
So the exposure draft was released at the end of July, and the comment period ends at the end of September.
Okay, great. Well, we've actually got an in-depth out there. I'm just reading this off here that I get the title correct. It's called A Deep Dive into Draft Amended IFRSs, and that covers the omnibus package that you talked about and the proposed amendments as well. Right? So that's a good read.
Yep.
Okay, great. Thank you, Olivier. Is there anything else of relevance on the IFRSs? I've read about voluntary standards, VSMEs. Is that something?
Yeah, absolutely. So as I said earlier, the CSRD is under revision. And one of the aspects that the European Commission is trying to do is to reduce the number of entities in scope of the CSRD. So which means that some entities that would have been in scope will be excluded, and potentially some wave one preparers that have already reported in 25 based on 24 will be scoped out of the CSRD in the future. So then once an entity is out of scope of the CSRD, then the question is what do preparers do? So of course they could do nothing or just do what is required on it by the local jurisdiction. But the European Commission is also offering a reporting frameworks that could apply to those entities that are outside of scope. So it will happen in two stages, or for two types of companies. The very small ones, below 250 employees. And for that, the European Commission already released a recommendation in July, which the recommendation does present a framework of reporting, which is a very simplified version of IFRS. And something that will come next year, probably mid-2026, and that time it will take the form of a delegated act, and that will be also a standard for smaller entities, at least those not in scope of the CSRD. And which will be based on the first one that was released as part of the recommendation. So that's the objective.
Okay, thanks. I think that covers a lot of the key developments on the IFRS front. What about the IASB? Any key developments to mention here?
Yes. So from an IASB's perspective, the IASB is currently working on the enhancement of the SASB standards. So what are the SASB standards? It's a set of standards which are specific to sectors and actually covering 77 sectors. So why are the SASB standards important? They are important because the IASB standards, so IFRS S1 and S2, but also the IFRS framework, are both referring to the SASB standards. So from that point of view, they are important. So, but now why does the IASB work on a revision of the SASB standards? Various reasons for that. One, because the SASB standards, when they have been developed, and they are currently used as well, they've been used as a standalone framework. not in contemplation or in conjunction with IFRS S1, S2, nor with ESRS. So now there needs to be some alignment between IFRS S1 and S2 and the SASB standards. Another reason for that is because when it has been developed, it was designed for the US market. So now there is an objective to make it more global so that it can be applied in all jurisdictions. Another reason is to make it and make sure that it is still relevant. So those standards have been developed a while ago, so it's to update them and keeping them relevant. Then it's also about interoperability. I mentioned interoperability earlier. It's also about making sure that it is working in harmony, not only with IFRS S1 and S2, but also with the ESRS framework. So to do that, the IASB is working on that project of enhancement, and it will cover. They will start by doing that primarily on 9 sectors, so 9 standards, 7 which are primarily mining related, and others which are dealing with food processes. And in addition to that, they will also cover some aspects that are that apply to 41 additional standards. So that will give rise to some future improvements to the SASB standards.
Okay, thanks for those IASB updates, Olivier. Just for viewers, we will of course link all the materials that we have mentioned during today's webcast in the description that you can find then on Viewpoint. So I guess that takes us to the end of today's webcast. I would like to thank Martin, Helen and Olivier for your expertise and for your input today. It's been really valuable, really interesting. And I'd also like to thank our viewers, of course, for taking time and listening to this webcast and listening to the discussion. We hope you found it useful and informative. And again, we hope to see you then in a couple of months for our Q4, December 2025 IFRS Update webcast. So for now, thank you very much and goodbye.